Hello, everyone, and welcome to another episode of our Powerplay Tuesday, where we have a great guest speaker on to join us to teach us a little bit about residential investment market updates. Always a good little bit of information halfway through the year, kind of getting those recaps and what we can prepare for the rest of Q3 and Q4. So today we have, like I said, Rosch, who will be sharing some information. But real quickly, I will just run through a couple of quick slides. My name is Sarah Shellum, and I'm one of the IRA specialists in our marketing department here at Quest Trust Company, and love putting on these webinars for everyone to get the information and learn something new. Of course, all the education that we do put on is strictly for educational purposes only. So this is our disclaimer. Quest does not provide any tax, legal, or investment advice, nor do we endorse any products or services. So we do always encourage you to do your due diligence and all the information in the webinar as well. So just a little bit about self-directed IRAs and what you can invest with. A lot of people ask, what is a self-directed IRA? And really, self-directed is really just a term used to describe that you are allowed to invest in what you know best. So self-directed IRAs, you get to choose your own investment. But really an IRA is an IRA is an IRA. The IRAs that we hold here are the same IRAs that you would see at a more traditional custodian. What we specialize in here is holding private investments like real estate, promissory notes, or private entities, as you can see here. So if you want to learn more, you can definitely scan this QR code, get some more information, schedule a consultation with an IRA specialist, and we would be happy to reach out and provide some more information. So with that being said, Rosch, I'll go ahead and let our IT team bring you up and take me and my slides down, and we will let you take it away. If anyone's there. If not, I will go ahead and unshare my screen and try to do it.
Okay, looks like I'm there. So I'm guessing I can be heard. Let me just get these slides up.
Certainly.
And all right, looks like we're in business. So thanks a bunch, Sarah. I'll try to keep to this to maybe about 30 minutes, not too long, because I know it's a work day, so we can all get back to work. But first and foremost, thanks to Quest Trust Company. I listened to so many of these webinars, have learned so much, but more importantly, connected with a lot of folks. I've actually invested in some deals with people that I met through at Quest. So as they say, your net worth is in part a function of your network. Quest Trust Company has definitely made a lot of folks, I think, wealthier in that regard. I'm going to get another set of disclaimers out. You already heard Sarah mention this, but I've got to mention it as well, just to be careful here. So this is for educational and networking purposes only. So what I'm doing today is we're going to do a residential market update, more specifically, single family residential. And even more specific than that, looking at properties in Houston. So what I wanted to show was, hey, these are kind of the cash flow profiles. Should you go out and invest in single family rentals in Houston, this is kind of cash flow expectations that you could expect. So to make it as accurate and informative as possible, I use actual real numbers. So these are actual properties with real rent estimates and maintenance estimates and insurance and HOA and property tax and all that good stuff, so that it's even more educational and accurate. We're not using, theoretical or subjective numbers, but to make sure that it's educational only and that there's no impression of anything being sold here, I've redacted all the property specific information. So I'll be able to share what neighborhoods they're in, why we select those neighborhoods for educational purposes, but just property specific information I won't be able to share or disclose, what the specific address is, as these are real life properties that, And then the second one is just no affiliation with any organization. I'm here as an individual, so I'm not selling anything, not soliciting any securities or anything like that. Really, it's to help expand my network, to get out there, and at any point, more importantly, honestly, just want to connect with any folks in the audience. So on the bottom left is my link to my website. You can visit inserviceinvestments.com And there's a way that anyone who's interested can connect with me there, join my monthly newsletter. And on the bottom right, you see my email address, rosch@inserviceinvestments.com. So if you want a copy of this PowerPoint, or you want any market data on residential investments in Houston, even Austin as well can provide that, and even a copy of this underwriting model, as you'll see. So moving on now to the second slide. And I'm going to try and keep it as lively as possible. Sometimes this stuff kind of gets a little bit routine and boring. So pardon me if just putting in as extra energy as I can. So what I did was I actually maintain a screen. And by the way, I'm a licensed realtor, so I have access to the MLS. And that's kind of where I pull all this data from. It's from the MLS from Houston. So that shows us, what properties are for sale, for how much, but also we can get very accurate rent estimates, see appreciation rates over time, rent growth trends over time, things like that. So very good and important data. So I take all the active listings in the city of Houston, and then what I did was I screened all of them for return potential. And that return is really based on the initial yield when you go out and buy the property, the rents that you get, and I'll show you how I estimate rent versus all the expenses that those properties will incur. Again, estimated projections, and for educational purposes only, to try and compute, okay, what are initial yields, or rather entrance cap rates, I call them, for single family rental properties. And then how do they compare to multifamily, for example, so we can see, at least from a yield basis, where are we getting some of the better returns or have more likelihood to get higher projections. So from that screen, I kind of take the top 5 percentile, and of that top 5 percentile of what I deem as to be the best return projections, I'll show you here how exactly that's calculated. I'm taking 3 assets in particular and saying, look, let's look at it in more detail and kind of run through those numbers together. So this would be that first asset. Again, across the city of Houston, screen probably 200 to 250 properties, the top 5 percentile, and then from that top 5 percentile, just taking the top 3 properties as a sample set. So again, over here for just certain reasons redacted the specific property information, but this is one of the top 5 percentile rentals. And as an update on the residential investment market, what could we expect? What kind of cap rates are we trading for? How are purchase prices going or trending in this market? And as you all know, this is a very interesting market that we are in today. So for the last couple of years, 3 years almost, we've been in a higher interest rate environment, higher relative to, that 2008 to 2021 period where essentially money was almost free. So it's just a lot of cheap debt that fueled a lot of appreciation in real estate. And we don't have that tailwind behind us anymore, at least in my opinion. So it's much more focused on what assets can we go and buy that without even assuming a certain exit sale price on the property, just by holding it for the long term, how much yield or cash flow can we expect? So this is a good example of kind of the best you can get, at least within the city of Houston, according to my screen. And it comes up in Conroe, Texas. Let me just mention something about Conroe. And what you'll notice is that oftentimes, again, based on my logic and projections, usually the best residential investments, single family in particular, are usually outside of the city. Inside the city, the rental rates are higher, but the purchase prices, they go up disproportionately even more so, such that the return on investment, in my opinion, actually dwindles down as you get closer inside the city, because the entrance purchase price just gets starting a lot more expensive. Whereas when you go outside the city, the purchase prices start getting a lot more affordable. However, you're still in really great neighborhoods. So Conroe, for example, the purchase price on this property, if you see on the top or right, kind of where I'm indicating my mouse, if you can see it, was $229,000. So this is an actual property in the last 6 months that sold, to give us a good idea of what the residential market is like. And another thing I want to point out is they're actually originally listed for $239,000. So again, affordable. First thing that this tells us is for residential investments, rentals in particular, at least across the Houston, market, very reasonable to be able to get something under $250,000 with decent initial yields. So that's kind of the first data point on what to expect, or as far as a market is concerned. Entry-level homes for a tenant and an investor to find a good property that's mutually beneficial for both. And again, here in the city of Conroe, they get cheaper when we go out into these outerlying suburbs, but the areas are very nice, very well equipped for families to grow up and raise children. And yeah, the other indicator here is, and this is one data point, but it is representative of a larger sample set, something I'm seeing quite often today, where we're getting $10,000, $15,000 off list price. So I would encourage anyone that's going out there, at least in today's market, check out, or at least try to potentially offer a 5% discount, or whatever your realtor or whoever you're working with, or even your own gut kind of tells you, to try and get something below list price. It's much more realistic today than it was 2 or 3 years ago. I mean, 3 years ago, 4 years ago, if I said something like that, you would have thought I was crazy. Just to get an offer taken seriously, everyone was making stuff at 5-10% over list price. Today, you're seeing stuff where it's the opposite. So that's advantageous for an investor. You can probably get a better deal. The negotiating power is more so on your side. Now, I'm showing the interior of the property. Why? And that's just to indicate, for this purchase price range, a lot of times we assume, oh, those must be dilapidated properties that need a lot of fix-up work. So here's kind of first another conclusion to take away, is that we can get very affordable homes for the investor, low purchase price ranges. So this was like 230,000, but not necessarily have to do a heavy amount of renovation work on the inside. A lot of these homes in that range, you will find, just like this, as you can see here, fully modernized on the inside, which is, a huge relief to an investor. It's a lot less work that you have to do in terms of, once you find a good property like this, you can then go and rent it out, start earning a return, within the first 30 days, and not really have to go through any extensive renovation. Now, of course, there are opportunities where the renovation might be heavy, but it's well worth it, because you get an even lower discounted price. Like just simply put, flipping a house. Although in this market, it's that exit of selling it that gets a little bit tougher, which we can talk about later. So here I'm just kind of showing how the lease comps are computed. So within a half-mile radius, homes of the same 3-bed, 2-bed, just to show the level of accuracy in these projections. We're taking stuff in the same neighborhood, very similar square footage, to determine an as accurate as possible rents we can get. And then we'll look at the expenses to try and actually determine what are the initial cap rates to expect on single family rentals. And that can then be compared to multifamily investments to see, where are we getting better pricing, better in terms of higher cap rates, higher initial yields, potentially more advantageous for the investor, such as yourselves. So these are these lease comps, just kind of showing them a little bit in more detail to show that, these are same neighborhood, very similar square footage. And you're seeing a range over here that's I see as high as or low as 2,150 up to 2,300. Again, this is an area, neighborhood that commands such a high rental rate, and still quite affordable, in my opinion, for the tenant. So now we're going into the actual model. And again, feel free to reach out anytime. You have my contact information. I'm very much happy to send this model over to anyone. And what we're doing is, we're just taking the median rental rate. So we have that range based on the comps of what actually leased out in that neighborhood, which, by the way, if you saw the amount of lease comps that were there, it's a clear indicator that, hey, being able to rent out these properties is not a problem. Clearly, there's lots of demand, as they're all getting rented out. And so I've just taken the median. I want to highlight that within that range of lease comps that we can choose from for this subject property, which is representative of a larger sample set to update us, what the residential investment climate is like, I'm just taking the median. So I'm emphasizing that because that's a conservative measure. You saw the inside of the property. More likely than not, it should be able to command a rental rate that's above the median. But for conservative purposes, let's just see, kind of in a very safe projection scenario, what kind of initial cap rates can we expect? So this, I'm taking out all the expenses, vacancy loss, leasing fee, warranty, repairs, HOA, insurance. Repairs, by the way, is actually, I've taken my own rental property, and what I've done is, I've actually, over the course of the last 3 years, taken the average expenditure that I put on a monthly basis. And these are older homes, generally in this price range. You're going to find there could be as old as 1980s, 1990s. So there is an additional maintenance expense that we have to be realistic about. Because they're older homes, you will face maintenance expense. But what I found is that it's worth it because I'm getting them for such a lower price. So we have that repair estimate in there. For my properties, again, in Houston, 1980s product, I've averaged spending $1,300 a year on maintenance. Now that sounds like a lot. Let's see if it actually ends up still being cash flow positive. So you see over here, the net profit from this property using even the insurance is a very comparable product that I've gotten quoted for what the insurance costs are like. And what I've computed here is $13,171 of free cash flow. That's after all expenses on a yearly basis from this property. So if you go all the way down, I think that bottom number, the bottom line, is the most important. Usually the most important line, the end all catch all from all these number pages, is just right at the bottom. What's the implied cap rate? And you see there it's 5.96%. So that's kind of one of the main takeaways from this presentation as far as the residential market in Houston, single family rentals, initial cap rate expectations. This is a very realistic metric or gauge I would use to say that these are kind of the initial cap rates, and something you can then compare to multifamily syndications or multifamily opportunities to make sure that should you take the extra risk or legwork in investing in multifamily, you're getting that additional reward. Otherwise, single family rentals may not be or may rather be a little bit more attractive than we normally assume. As you can see here, 5.96% initial cap rate. So what does that mean? That means basically for every $100 you've spent, you're getting back almost $6, $5.96 to be exact, of initial yield in year one. But remember, that yield increases over time. So we actually have that here in this model where the rent estimate goes up per year. And we're assuming a very modest, again, conservative measure of by how much rents will grow. So I'm saying 2.5% per year is how much will increase the rent. And if you ask me, I'd say, that's conservative. A lot of folks might then say, hey, could you do 5%, 6% a year? And I'd say it just depends on the market that you're in, how much demand there is. However, I would caution in the past, like 2022, 2023, and definitely 2021, the annual rent growth over there, those were peak years. So we shouldn't look back at those years and say that, hey, this is how much rents grow per year. Because those years were, to be honest, anomaly years. So whatever you saw in rent growth in 2022, that's out of the norm. That's not reasonable expectations. But let's go forward. So here is that same asset. And again, we want to see what that implied cap rate is at the bottom. But what I did on this asset was I got a little bit more aggressive in the sense that we saw the inside of the property and we know that, hey, this is not an average product. It should probably go towards the top end of what rents are in that neighborhood. So I still kept it, below the highest renting property in that neighborhood, but I brought it further away from the median, increased the rental rate. Previously, we were assuming $2,300 a month, the median rate. Now here I'm assuming $2,500 a month. And this is kind of more realistic as far as how I would go about it. But I wanted to show both scenarios. One is the conservative approach. The other is a little bit more aggressive approach. I will say in the past with my properties, I kind of regret a little bit being too conservative in the beginning. That was just because, I was a little bit nervous, wanted to make sure that I could get rented out quickly. And I did. For my last property that I leased out, I had over 20 applications, no shortage of well-qualified applicants with good credit, good jobs. And but a lot of it was because I was offering a fully renovated on the inside product that was at median rent. And so I definitely left some money on the table. So that's why I always make sure to run this scenario now and say, if we charge it a higher rental rate. So in this case, I'm just going up to $2,500 a month, which again, for the lease comp range that we saw over the last 12 months is still very reasonable. Now you see the implied cap rate go up quite a bit. So on the bottom over there, after calculating all the expenses, what that net cash flow is, it's coming in around 7%. So this is very substantial, that implied cap rate. It's very hard to find properties that sell for as cheap, as good of a yield, as attractive as an entrance cap rate or purchase price for investors these days at a 7% cap rate. So if you ask me, is that reasonable? Can we find it in Texas at least, or maybe more specifically in Houston? I'd say, hey, you don't have to take my word for it. These are real properties, real listings. These are real sample sets that I've produced from the live MLS, just redacting the specific addresses to show and answer what are realistic expectations for entrance cap rates in single family rentals. And we've seen here basically 6 to 7% for kind of that top fifth percentile. So I'm going to run through two more of these properties, and I'll go a little bit quicker because it's more or less the same information. It's just that I wanted to show 3 properties in total to kind of give a more accurate sample set or representation. And then we can kind of at the end conclude, okay, what are those entrance cap rates on single family rentals? And I also just want to mention, again, I do this so that I can reach out and network with other investors. I am a licensed realtor, so in any way I can be in service to anyone. Just go to my website, inserviceinvestments.com, and there's a monthly newsletter that I hope folks subscribe to. There's also a WhatsApp group chat that I only send a message out once a month, just a quick update on kind of where I'm seeing the best opportunities, so that it just kind of please join my network, basically, is what I'm getting at. So this will be the second property. Now, this is Lamarck, Texas. So for those that are perhaps unfamiliar with Houston, Lamarck is another very good neighborhood south of Houston. Conroe was north of Houston. So again, on the outer lying areas of Houston is where we're looking at. And what you see here is, again, even cheaper. So this was listed for $180,000, sold for $170,000. So once again, we're seeing that buyers are having a little bit more negotiating power in the single family residential market, as a lot of folks are getting priced out from these higher mortgage rates. And so you have more negotiating power, as I said, and there's properties out there that let's look at the interior for $170,000. You can see certain amenities probably could be upgraded, should be upgraded. For example, on the top right, that old school electric stove or gas stove, rather, I would update. And honestly, to update appliances, it's really not that expensive, but it makes a world of a difference for the tenant. So I find it to be well worth it. Usually on the last property that I did, I went in there and I definitely put in a new fridge, washer, and dryer, and all in, I think it was like less than $2,000. So it's not free, not by any means, but relative to the purchase price, it's a not so large of an expense, and it really makes a difference for the tenant's experience. So I'm seeing some questions over here as far as what were the purchase prices for these properties. So again, Rosch at inserviceinvestments.com, just addressing some of these questions as they're popping up. If you email me, I can send you this deck, and it has the purchase properties. This last one that we showed was for the purchase price was $170,000, and the one before that was $230,000. Another question I see here is, are these returns based on an investor paying cash at zero cost basis? So I'm not sure what zero cost basis refers to. Cost basis, I understand, is your cost basis. How much all in the asset cost you to purchase it, to get it up and running. So it's usually going to be the purchase price, probably a few transaction fees, maybe some upgrades you make at the end, like those appliances and whatnot. So that's what these returns and initial yields, rather, are based off of. That's the denominator, is the purchase price. And then in some cases, you can assume a few extra grand. If you go into my model, you can actually toggle that assumption, how much additional work you want to put on there. But for the most part, most of these properties are ready to go. Apart from certain things I just mentioned, like maybe you want to include or upgrade some appliances. And then here, so back to that asset B, you see the sold lease comps range. So the rental range is lower over here, 1,300 to 1,600 to 1,700, but also the purchase price is lower. So we're looking for not necessarily the lowest purchase price, not necessarily the highest rental rate, but that perfect ratio between the two. As low of a purchase price, but as high as a rental rate is what we want to get. And so it's more of that equation that we're going for, as opposed to just one variable over the other. So again, this is asset B. What is that initial cap rate? And over here, it's lower than what we showed in Conroe, 5%. So it's just to be fair, hey, let's in the top 5th percentile. So we saw a 6 to 7% ranging cap rate on entrance. Here we're seeing a 5%. And I'll turn over to the next slide. And again, what we're going to do is, this one is showing at the median rental rate. So what I say is a conservative estimate, kind of our base case. And then we up it a little bit and we go and see, okay, now if we charge $1,700 a month, as opposed to 1,600, so getting closer to the high end of the rental range, how much is the cap rate increase? So now here we have a 5.75% cap rate. So basically, I'd say on the low end, we're coming around high fives. So far, the highest we've seen is 7% for single family rentals in Houston today. Real lifetime data. All right, now let's move on to the third asset. And again, as I mentioned, inserviceinvestments.com, you can subscribe to the monthly newsletter and get a copy of this and access to all this data, as well as the underwriting model where you can literally plug in the MLS number for your subject property, and then it'll pull the county tax info and insurance estimate and things like that. So on this third asset, and this one is actually technically inside the city limits of Houston, but it's for those that know Houston, it's basically Missouri City. And this one has a purchase price of $165,000. So again, the 200 to 250,000 range is where I target. Because if you go below 200,000, you can still get good deals like this one and the prior one that I showed. But usually what the difference is, it's not necessarily in the quality of the home, but it might be more so in the neighborhood. So, I mean, I went to high school in Missouri City, so I know Missouri City real well. So I think it's a great neighborhood. Conroe, for whatever reasons, just commands a higher purchase price. So it's up to you as the individual investor. I'm not going to, in my opinion, all these neighborhoods are great, but you could probably rank one as better than the other and choose from there. And most notably, it's probably going to be off of school districts or crime. But honestly, all these are pretty good places to live, in my opinion. So on this one, you just seen photos on the inside. It's a smaller unit than what the other two were, but it also has a much smaller purchase price. So you are getting compensated. There's always a trade-off in investing. You get maybe better pricing, but then maybe you'll sacrifice something on rental rate, one thing or the other. Sold lease comps, just listing those out. All right, now let's see, what's that initial cap rate? So this one's a lot higher, 7.66. And again, this is taking the median rental rate. And this is more so a function of, it's just a very sweet spot in terms of the purchase price was sub 200,000. But the rental rates are pretty high. This is $1,850 for the median rental rates. Remember, I said we're not going for the lowest purchase price. I mean, we are, but at the same time, we want that trade-off for the also higher rental rate. So this is probably one of the best properties that I could pull across Houston to get the best trade-off between those two. High thousands, close to 2,000 monthly rent, but under 200,000 for the property. And you see that initial cap rate there is 7.66%. Now, if we up the rental rate closer, not past the median, closer to the high end of what those neighborhoods in that home, if you wanted to get a little bit more aggressive, if you felt that based on the comps that you looked at that, hey, I'm offering something similar or even top of line, perhaps you've done a little bit of renovation work. If you want to spend an extra $1,000, you can then find out and see, well, for the additional rent that I'll be able to charge, is it worth it? Now we get to an 8.36% cap rate. So that's down there at the bottom. So I mean, cap rates for what we've seen is basically, I would say 6 to 8% on entrance. And now I've got my very astute, intelligent, and critical audience asking some questions over here. So I'll go with Jim Kittredge. How is management so low? So management over here is calculated as 5% of the rents. Now, a lot of folks, I think, out there, property managers are charging as high as 12%. Me personally, I pay 5%. If you reach out offline, I can connect you with some property managers I know where it's 5% of monthly rent, as well as 1 month's rent. So when they bring in the tenant, they're going to take that 1 month's rent. So if you're paying 12% for property management, I would highly suggest shopping around. You probably definitely could get a better deal. And honestly, if you have just one, maybe two properties, I really think one is better off just managing it themselves. But to each their own. Management, really just requires leasing, invoicing, and then responding to maintenance requests. So if you wanted to hire it out, I'm sure that's well worth it. 5, 6, as much as 8% is realistically what I would pay. In this case, I'm modeling in 5% because that's what I'm getting. But if you wanted to go in there and toggle those assumptions, I'm sure that'll bring the cap rate down a little bit, but it'll still be in that 5 to 8%. And if we narrow it down further, 6 to 7% range. And then there's a question on interest paid. So these are all unlevered properties. So that's actually a very good question. Thank you, Abundant Capital Group, for asking that. These are all unlevered cap rates. Cap rate, by definition, is your net operating income over the purchase price. So net operating income is before any debt service. So this is the all-in purchase price, had you paid all cash, and then all the expenses, the unlevered cash flow yield, the actual cash flow to you. Now, if you want to go in there and toggle with debt, I would say reach out. I actually have that built in the model where you can say how much of a down payment you want to put of the purchase price, and then also input your interest rate. And I will say, with interest rates where they are, I find it more advantageous to purchase these properties all cash, or rather do it through some type of syndication where you and a few of friends or fellow investors in your network pull money together, and then that way, you might not have enough cash to buy an entire property outright, but in a group, you perhaps could do so without having to use debt. With interest rates where they are, your yields are going to be higher. However, if you reach out, I can send you the model, and you can toggle in those interest rate assumptions that you're getting and the amount of debt that you want to use. And what I found is basically you can still cash flow positive, just to cut to the chase, because I think I know what everyone's going to wonder is, well, what is it like if you use debt? I'd say what I saw in my screening model was if I go up to 40, 50%, it brings the initial yields down a little bit, but not too much, like less than 50 basis points. So I'm still cash flow positive. But once I started going past 50% LTV with interest rates at that close to 8% or over 8%, the cash flow just starts getting too thin. And that's kind of just the reality that we have to face. And that's actually a great segue to my last slide over here. So I promised I would keep this short. So final thoughts, just generally on underwriting, because I feel like we get so much information as investors, so many models and projections thrown at us. And this is where, particularly in multifamily syndications, where you have to trust the sponsor are making appropriate and conservative assumptions, kind of like I touched on. And I gave it two scenarios, a base case and a more aggressive case. So what I find has made things very simple for me that I want to share with y'all is kind of two metrics that I feel are extremely important. One is being that initial entrance cap rate, because what happens is sponsors or investment underwriters can kind of show you a projected return, right? So I look at all these deals and they show me projected IRRs in 10 to 15% or 15 to 20%. But in those IRR calculations, what rent growth assumptions are they using? Are those realistic? How much CapEx are they putting on the property to renovate it? Is that realistic? Are they going to go over that budget? By what amount are they increasing expenses on the property, insurance and taxes? Is that realistic? But most importantly, one of the trickiest ones is they're assuming an entrance cap rate, and then they're assuming an exit cap rate 5 years out. 5 years from today, we don't know what interest rates are going to be. So anyone can go in there and say that, hey, I'm going to buy today at a 5 or 6% cap rate, but I'm going to sell in year 5 for a 3% or 4% cap rate. Why would someone 5 years from today, pay a 3% cap rate or 4% cap rate? I mean, we don't know what the interest rates are going to be. We don't know which direction pricing is going to go. So, I mean, we can make an estimate, but what I'm saying is, each sponsor is going to have a different estimate of their view of what the exit cap rate will be 3-4 years from now. So that's when the assumption itself becomes more subjective. That's when I say, okay, let's dial back from the IRR calculation itself. Kind of the three main numbers that are going into the IRR calculation are the entrance cap rate, which is based on the purchase price and the cash flows of the property today. And then the second number that they throw in there is the exit cap rate, which is way more subjective. And then the third number is, in the interim, how much our cash flow is increasing. So pick apart the IRR projection, and that doesn't mean you have to go into Excel. This is my quick and easy way is I'll take a couple deals because there's a lot of deals out there, which is great. And I hope more keep coming so that we can all keep investing. But I'll take the initial cap rate across those deals. And generally, the one with the higher initial cap rate is getting better pricing. So from day one, they're just entering at a better cost basis, a better purchase price, which means more likely than not, so much of the return, it just comes from that initial purchase price. Are you getting a good price or not? However, we will sacrifice a lower cap rate, a a lower initial yield if we can also then get higher growth in the cash flows in year 1, 2, 3, 4, 5, etc. It's just that when we get to year 2, year 3, year 4, it gets more subjective. So both numbers are important, and I will sacrifice a lower initial yield if it means higher growth in the cash flows. However, me personally, I weight more so towards the initial cap rate because that's real numbers based on today. That's less subjective. But anyways, point of that all is just quick and easy way to evaluate different deals, 2 metrics, compare them across the initial cap rate that they're entering the investment on, and then also checking to see what the growth assumption is in those cash flows. And between those 2 numbers, if you kind of rank your deals, I think it'll make life a lot easier and hopefully help out in getting you the best deals. And yeah, just that graph on the bottom, quick update on interest rates. So, I think today we're at 5.33% for the federal funds rate, and there's a lot of talk and expectation and high probability that rates will get cut, hopefully sometime in September. But we don't know that for sure. And I just wanted to show this chart to emphasize that, where we are today actually isn't as high of an interest rate as you think. If you look back over time in the history of the Federal Reserve, which is what that chart is over there, the effective rate that they've charged, you'll see that we're kind of, in an average or modest range at this 5 to 6% interest rate. What happened in 2009 all the way up to the pandemic was, an exceptionally low period for interest rates. So if you believe in the law of averages, that would imply that perhaps we might have to stay higher than most folks would like. And so I'm not making any projections on interest rates. I hope they come down. That will be beneficial for investors, no doubt. However, just cautioning, and that's kind of why I'm emphasizing in the underwriting, let's look at the initial yields from day one, because irrespective of what estimate we make on the exit, are we making cash flow? Are we generating a little bit of a return month after month so that we don't have to sell? And if we just hold it for the long term, are we making money? Are we making yield? Are we getting a return? So I think with that, I'm just going to look through these questions, see any Landalysis Information Services. Do you buy at a lower cap rate and sell for a higher one? That's kind of one of the major points of this presentation was I'm just looking at what the entrance cap rates are of absolutely by all scenarios. I want to sell for as high of a price as possible. So I want to sell for a lower cap rate. That implies a higher price when I exit. But as far as this update is concerned, for purposes of this presentation, is just looking at the entrance cap rate. What can we kind of realistically expect? Yeah, and I think with that, I'll turn it back over to Quest and finish up our lunches here, and then we can all kind of get back on with our day.
Awesome. Thank you so much for that presentation. It was really good. I was able to, listen in on a little bit of it. I was kind of walking around getting some things taken care of, but it looks like we had a lot of questions. So hope you enjoyed the presentation. And then, if you guys want to go back and rewatch the presentation afterwards, it'll be available on our YouTube and on our Facebook page. And you can always join us for our Saturday class as well. We stream these webinars every Tuesday and every Saturday for y'all to get education. But Rosch, thank you so much for joining us for the presentation today. And thank you everyone for being a part of the presentation. And we hope to see you next time.
All right. Thank you all.